You do not want to miss this episode. We're going to break down what is infinite banking, how does it work in Canada, and we're actually going to give examples with math and comparisons. You're going to love this. Hi, everyone. Welcome to Control and Compound. I am Darren Mitchell, and joining me as always, Christina Wyatt. Christina, how are you doing today?
Hey, Darren, I am doing awesome. I'm excited for this episode because it's been a while since we dug into what is infinite banking. What is the infinite banking concept?
Yeah, I think it was overdue that we revisited this topic, because it's probably the question we get the most when people first kind of hear about this or see us speak or come up to our booth at a conference. They're like, well, what is infinite banking? So I thought this would be a great opportunity to kind of go through it and then give examples, because we got some feedback that people are wanting to see actual examples of how you'd use it. And, so yeah, I'm excited.
Yeah. Before we dive in, though, I want to remind everybody, if you're listening on your favorite podcast platform, please make sure that you subscribe and leave that 5-star review for us. And if you're listening or watching on YouTube, please like, subscribe, and don't forget to hit the bell button, because that's where you're going to see all that new content come out. And then don't forget to follow us on social media at Control and Compound on Instagram and TikTok.
All right. Let me start with just kind of doing a brief overview of what is infinite banking. So imagine being able to use the same dollar over and over and over again. In other words, I could save my money for retirement, and I could use that same dollar to go buy a piece of real estate. And I could use that same dollar also to go start a business or invest in a course to make myself better, and use it for retirement and use it to leave to my family. Using that dollar over and over and over again, that same dollar, well, that's the promise of infinite banking. So we're going to talk today how that works. So the step one before you go investing anywhere should always be, where do I save my money? So step one is where do you save your money? And the most tax efficient place, and what we think is the best place, and what many Canadians think is the best place to save it, is a specially designed high cash value life insurance product. Now, this is a very unique product. Less than 1/4% of policies in Canada are like this. Okay. So it's important to be dealing with a firm that specializes in this, because you can set it up poorly and it just doesn't work the same way. So step one, you save in this cash value life insurance. There's two components of there. There's a cash value and there's a death benefit. And both of these are going to compound tax-free for the rest of your life, guaranteed. Tax-free, guaranteed growth till the day you die. So let's fast forward a couple of years down the road, and all of a sudden you want to get into the real estate world. You want to buy a house, you want to buy an income property. Well, instead of taking that investment you have and saying, I'm going to cash it out like most people would do in order to buy this other thing, right? It's an or asset. Do I do these savings for retirement or the house or the real estate or the business? We're going to say, no, we're going to leave it in the tax-free cash value there, compound it, continue to compound it till the day we die. And I'm going to use the insurance company's money to go take advantage of this real estate opportunity or business opportunity or financial emergency. Now, why would the insurance company give you their money? Because one of the features of this product is guaranteed loans up to 90% of your cash value. When we say guaranteed, no financials, you just ask for money, they give it to you. The only person that approves the loan is you. So you take this loan, you buy some real estate, you buy a house, you buy a business, whatever it is, you pay that loan back in a couple of years or whatever you want to. You're totally up to you when you pay it back. You rinse and repeat. Now we're still compounding exactly the same whether we had taken the loan or not. Then 5 years down the road, you do another opportunity. All of a sudden the market's down 30% and Bitcoin drops and real estate's down, and you say, hey, what a great opportunity, but no one's loaning money. Well, you get guaranteed loans, you access money, you take advantage of another opportunity. You do that over and over and over again. You hit retirement and you have way more money than you would have otherwise, because you stayed in control. You were in control of your money, so you could access money whenever you thought was best. Now you hit retirement, you get all this cash value. What do you do with it now? Well, now we can take tax-free loans, I don't know, 100, 200 grand a year, whatever your numbers are, and say, let's use those tax-free loans to top up my retirement lifestyle. And these loans you never pay back until death. What happens at death? Well, remember we had two components, cash value and death benefit. Well, that death benefit is one big old ball of tax-free cash now, and that gets paid out. Portion of it is used to pay off the outstanding loan from your tax-free retirement income, and the other portion goes tax-free to your family. So that's the infinite banking concept. That's why there's over $100 billion of cash value life insurance in Canada. That's what Canadians are using, and that's what wealthy are using to save their money, invest their money for opportunities and emergencies, retire tax-free, and leave a tax-free legacy. All right, Christina, that's
a wrap, Darren. I think you covered it. I think you covered it all. No, that was a great overview, though. I think we should dig in a little bit deeper, though, because amazing overview of the strategy itself and what we can use it for, but maybe diving a bit deeper into each of the components. Sure. That's all. So I think we should start with the product. So as you mentioned, the infinite banking concept. It's a strategy, but we use a specific product in order to set it up. And the product that we use is a participating whole life policy. And that participating portion is very important because that means it pays dividends each year out to the policy holders. So not only is the participating whole life important that we use that product, it's also important that we design it a specific way. So when we design these policies, we drive down the death benefit, we drive up the cash values. So you could have a whole life product, you could have a participating whole life product, and it might still not be designed for the infinite banking concept because we really want to maximize that cash value, and there's a special way to do that. So we design these specifically for high cash, and then each and every year we take the dividend as a paid up addition. So we don't take the dividend as a check. We keep those dividends inside the policy, and they increase the cash values and they increase the death benefit for us, like you had mentioned. So our dividends, which have been paying for 150 plus years in some cases, these insurance companies that we work with have had this product for 100 plus years, the youngest one being 100 years. So each and every year they pay out that dividend into the policy, cash values grow, death benefit grows. So the death benefit is there for the beneficiaries to be able to pay out that loan, and the cash value is there for you to be able to use for all those opportunities and for your retirement.
Great overview there, Christina. So I want to talk about the loans, and really, again, control is so important. You want to be in control of your money so you can decide when it's the right time to take advantage of opportunities. And the key to this is when you're in control of this policy, you decide whether it's time to get a loan or not. So you're not relying upon the insurance company. You're not giving them financials. It's not showing up on a credit report. You're just saying, hey, this is an opportunity. I want money. Give me your money. Guaranteed loans up to 90%. Same for emergencies. There's going to be financial emergencies. I promise you. Something's going to happen. You're going to go, holy crap, I need money. Well, you don't have to have a fire sale when the market's down or your business isn't doing well or you deplete all your cash. You just, great, you have this cash value life insurance, you get a loan. And you can pay that loan back on your terms. If you want to pay it back in 6 months, cool. You want to make no payments for 2 years and then pay it back, that's great. If you want to pay it monthly and get it paid off in X amount of years, and then all of a sudden you change your mind 3 months in and then you change your mind again in the next month, you can do all that because you are now completely in control of this. And again, the whole time you're using these loans, your cash value grows exactly the same whether you have a loan or not. Because one of the misconceptions you hear is, why would I pay interest to borrow my own money? You're not borrowing your own money. Your money is staying in the policy, compounding tax-free forever. You're using the insurance company's money. So huge advantage there. And the loans, if you're using them for an opportunity like investing, the interest is tax deductible. So again, huge benefit there. Write off the interest on the loan and get the loan whenever you want, pay it back whenever you want.
And asset instead of or asset. We got our money working, which brings me to why do wealthy individuals use this? You mentioned there's billions of dollars going into these policies every single year. Why are wealthy individuals using it as a strategy? Well, the first thing that we talk about is control. Wealthy individuals know that we have to save or store our money somewhere, right? And we want that place where we save. It could either be cash or it could be cash value because those two places give us that complete control of our money. So wealthy individuals will use this as a foundation to their financial plan. They'll save inside of the policy, grow those cash values tax-free, 5 to 6% every single year. They're going to grow those out, but then they're going to multiply their money. Just like you mentioned, they're going to take that money and they're going to put it back into their other investments. They're going to put it in their business. They're going to put it in themselves, put it into real estate. They're going to multiply their dollars. Now they've got their money working in more than one place at one time. And that's how wealthy people really come out on top, right? They've got their money working. So we've got that place of control. We're multiplying our dollars. We also have uninterrupted compounding in here. And this is important because people say compound interest, it is the most important thing. No, uninterrupted compound interest is the most important thing you can do for your wealth. And when we put our money into this high cash value life insurance policy, it's going to compound tax-free inside uninterrupted for the rest of your life. Spending your money isn't going to pull it out of that account, right? We're not going to spend our money. We're going to spend the insurance company's money. Taxes are not going to take us off that compound curve. Fees very low inside of here, and volatility like we see in those markets, we're not going to have it in here, right? It's smooth, conservative returns. Volatility in one of these things, like standard deviation around 1%, stock market 16, right? So we've got very little volatility. We are compounding every single day for the rest of our lives. Imagine that, 20, 30, 40, 50, 60 years of compound growth instead of, pulling out for that next investment, pulling our money out of our investments and stopping that compound interest growth. So wealthy individuals know that in order to grow their wealth, they have to have their money working in multiple places at one time. They need to keep control of their cash, and they need to keep that compound growth happening.
Love it. Okay. So the next section I want to kind of emphasize and dig into a little more detail is retirement and legacy planning. So when we think of like a wealth planning, we talk about this retirement mountain I talk about in my first book. The first half of your life, you're saving money, you're accumulating money. That's like climbing the mountain. And then in the later part of your life, you're coming down the other side of the mountain. In other words, you're spending your assets. Your money's depleting, and then you're going to if you don't make it to the bottom of the mountain, you're going to leave some money behind. So, we often talk about this concept in the saving money, multiplying your money so it's in more than one place at the same time, staying on the compound curve. But when you retire, what do you do with it? Well, almost all life insurance you buy for someone else. You buy for life insurance. What's going to happen to my spouse and kids if I die? I need life insurance. You buy this type of life insurance for you and your spouse because you get to spend it in your lifetime. Now, what do I mean by that? You retire, you get a bunch of cash value. You can take tax-free loans, and you can take, again, whatever, depending how much cash value you have, you can take 50 grand one year, 100 grand the next year, 20 grand the next year, 200 grand the next year to do that trip to Australia, New Zealand, the trip of a lifetime. Just almost like a line of credit that you can take those loans when, how, and if you want. Choose not to pay them back in retirement because you're going to have this huge death benefit that's going to be able to pay off those loans and leave a bunch of money behind. And Christina, we deal with estate planning, death all the time in our business. And, when death happens, first of all, it's sad and someone dies. And then as soon as the dust settles on that, there's almost always some issues or some problems, right? Especially the wealthier you become, the more issues and the more problems. It's like, how are we going to divide this up? Who gets this? Who gets that? What do you mean we owe all this taxes on the business? What do you mean we owe all these taxes on the real estate? Are we going to have to sell the real estate? What about the family cottage? The family cottage that mom and dad had forever. Now we got to pay hundreds of thousands of dollars just to keep it. Well, our experience is, and we've got a lot of experience in this, you know what can solve almost all those problems? A big bag of tax-free cash. And that's really, again, another huge benefit of this. Instead of having no life insurance, like a lot of people have by the time they hit retirement, thinking, I don't need any life insurance when I'm retired. Okay. What's going to happen to all that work you spent an entire lifetime accumulating? What's going to happen to the family dynamics when your kids can't get along about how to split things up? What's going to happen when one kid's involved in the business and the other one isn't? Or what if you're a farmer? I mean, it gets exponentially worse. So there's all kinds of benefits of that tax-free death benefit. You can spend what you want in your lifetime, and the rest of it is going to solve a lot of those problems. Maybe you want to leave money to charity. Maybe you want to help your kids. Maybe you want to help some grandkids. You don't decide now. You get all kinds of time to decide it. But retirement and legacy benefits are massive.
Yeah, absolutely. Now, the last one that I want to touch on before we dig into the numbers is working with someone that specializes in this strategy. So there's a lot of people across Canada that can sell life insurance. They absolutely can. There's lots of licensed individuals. There's maybe a handful of us that specialize in the infinite banking strategy and high cash value life insurance and how it can work for you. It's very important to work with someone that specializes in it because it can absolutely be done wrong. And I've seen it many a time. So a few things to keep in mind are picking the right product, like we talked about. I've run into numerous times where people have been set up for the infinite banking concept and they are not using the right product. Second piece is you have to make sure that it's structured for those high cash values. There's a specific way that needs to be done. So we want to make sure that's done correctly. This is not like taking a 10-year term out with an insurance agent and not speaking them for another 10 years. There's lots of things that we do. We just talked about all of the different things that we can do for these policies. And you want to be working with someone that understands how that all works. You want, I meet with my clients all the time for strategy sessions on their investments that they're working on, how they want to do loan repayments. When it comes time for retirement, there's a lot that needs to be done there, right? You want to be working with someone that understands it and has done it. They should also be doing it themselves, right? That's very important. And another piece that I wanted to mention too is that for corporate business owners, this is like a game changer when it comes to corporate high cash value life insurance, and the strategy is a game changer, but it needs to be done correctly. And it's extremely important it's done correctly, which again is why you want to work with someone that specializes in this strategy in the product.
Yeah, and the great summary. I would add two things. The business owner, you're reminding me, I didn't even talk about in that retirement and legacy, the power of a corporate-owned policy through this capital dividend account thing we have, where all this tax-free death benefit, you can use cheap corporate dollars and pay out tax-free through the company to the beneficiaries, which is amazing. But I just thought, Christina, when you talked about the importance of working with someone that specializes in this, I would even take that a step further, and I would say a firm that specializes in this, because if you think this individual, are they going to be around for the rest of your life and maybe your kid's life? Yep. Because now we've got kids policies, perhaps we've got policies that may not pay for 20, 30, 40, 50 years. So that just having that continuation of, if this, Joe Blow that knows something about infinite banking, is no longer in the business or retires, like who's going to look after you then? So I think importance of dealing with a firm that specializes in it. Okay, so let's dig into our example here. So we struggled with this. We spent some time on this, Christina, because we're like, okay, who's like a typical person? Like, what do they have? And, we have multiple policies. We have personal policies. We have kids policies. We have corporate owned policies. We have policies on our spouses. Like, there's all kinds of different policies. So our typical person, if you learn about this concept early on, you're going to have 5, 10, 15 different policies throughout your lifetime, because as you grow and evolve, then, how the amount you can save and what you're looking to do with this and with the opportunities you can take advantage of are going to evolve and save. So instead of trying to take someone that has 5 or 10 policies bought at various different ages and some personal and some corporate or whatever, we just tried to make it really simple and say, let's take one policy that's representative of all of those group of policies I just talked about. So for this example, we're going to use a 25-year-old who's basically going to work for 40 years and put, they have to save every year somewhere. We're going to say they saved into cash value life insurance into this policy, $25,000 a year, each year for 40 years. Now, you're hearing this, and 25 grand for a 25-year-old might be a little higher than most 25-year-olds are putting in. But for a 55-year-old, maybe it's, especially 55-year-old 30 years from now, that's probably going to be on the low side. So it's, again, just an example. It's a nice round $1 million that goes in over that 40-year period too. So that's the actual illustration. So these numbers come off an actual illustration, not one that, we're guessing on. These are actual numbers. So if we look at a 25-year-old starting a policy at 25 grand a year, and they're contributing that for 40 years, the starting cash value, okay, remember we have two pieces, cash value, death benefit. Starting cash value, it's going to be less than $25,000. We're always underwater year one in these cash value life insurance policies. We have some setup costs. Insurance companies have to put money away in a reserve, so we're underwater. And then we have a starting death benefit. The starting death benefit is $800,000. So cash value less than 25, death benefit 800. Those are going to continue to compound till the day you die. Okay, so remember those numbers though, less than 25 and 800 grand. Okay, 25 years old, he or she starts this. Fast forward down the road, he's 30 years old. He goes, great, time to get a house, time to get into something. You know what? I want to buy a duplex. Takes an $80,000 loan for the down payment for the duplex. He goes to the bank to get a mortgage. They say, where'd you get the down payment? Borrowed from my cash value. Great. We don't consider that a loan. Doesn't show up on his credit report. He's able to get the 80% mortgage. No questions asked, or a couple of questions on the mortgage, but no questions asked about the down payment. Now at age 35, he takes a $200,000 loan and starts a business. 35 years old, time to have my own business. At age 40, now he takes a $200,000 loan, buys $1 million income property. Again, borrowed for the down payment. Okay. Another $200,000 he put in the stock market at age 40 because the stock market had just dropped 30%. And he said, what a great opportunity. I'm going to take advantage of this opportunity. Now, he's paying back these loans all along, but his cash value is growing exactly the same whether he had taken the loan or not. So now we call those and opportunities. His money's compounding tax-free, and he bought a duplex, and he started a business, and he bought an income property, and he bought the stock market when it was down 30%. Money multiplied, used in more than one case. Oh, and he has this ever-increasing death benefit. So now we jump ahead to age 42. And age 42, it was not a good year for him. He's got $615,000 of cash value now. Okay, that's great. But the business went sideways when he was 42 years old. He had the worst financial year of his life. The stress was awful. It was a strain on the marriage. You name it. It was a horrible year. So he said, what can I do? Well, the first thing it is, he stopped contributing to this policy. Maybe for a year or two, he did not contribute. And you have that flexibility because we've built up the cash value. Okay. And again, he's working with someone that knows what they're doing. And then he actually took a $200,000 loan to help make payroll and just get his business to survive. Now, he did survive that tough year or two, didn't make any contributions. Then business came roaring back and he said, hey, can I go back and make up those deposits I missed? Sure can. We built the contract. We built the policy designed for that. Pays back the loans, continues to chug along. Now at 45, he's in a great spot. And he goes, you know what? I'm looking for a little more control. I actually want to buy the building our business is in. So he takes a $200,000 loan and he buys the $1 million property, takes another $400,000 in his cash value, and he buys his biggest competitor out. So now his business is growing. He's up to age 55 now. Okay. He's still putting 25 grand a year in, but he's up to 1.7 million of cash value now at age 55. He takes $1 million loan because he has an opportunity to 10x his business. He goes, I can make my business 10 times bigger. And the banks aren't going to give him money, but the guy in the mirror says, yes, you can have the loan. He approves his own loan, takes $1 million. He 10x his business. He retires at age 65. One of his kids take over. So he's traveling, doing some fun stuff. At age 70, he comes and he goes, all right, listen, I'm really wealthy now, or a lot wealthier than I would have been. This is really cool. I was able to multiply dollars, take advantage of all these opportunities in business and real estate, deal with a couple of financial emergencies. What do I do with this now? So he's 70 years old. He's put in $1 million, not up front, only 25 grand a year over 40 years. Well, remember his starting cash value was less than 25 and his starting death benefit was 800. Well, now at age 70, he has almost 4.3 million of cash value and 7.5 million of death benefit. Why? Because he never stopped compounding. He stayed on that compound growth curve, tax-free dividends every single year growing that. So he goes, you know what? We've got a bunch of money, but why don't we even have a better retirement lifestyle? So they're going to take $200,000 or $300,000 a year, tax-free loans. Think of that, an extra $200,000 or $300,000 a year in retirement, tax-free loans, just to travel the world and do all kinds of cool things, visit the grandkids all over North America. That's his retirement. Now at age 90, he passes away. At age 90, his cash value, okay, again, he stopped contributing at 65, but his cash value continued to grow. It's 10.6 million, and his death benefit is 12.4 million. So there's a $12.4 million tax-free death benefit that's going to get paid. If it was corporate, it would flow through the corporation. We're going to assume personal here. What's that death benefit going to do? Well, a few $1 million of it is going to be used to pay off the outstanding loan because him and his spouse were spending an extra couple $100,000 a year tax-free to travel the world, have a carefree retirement. So now maybe there's 7 or 8 million left. What are they going to do with that? Well, they're going to solve all those problems we referenced earlier. The child that took over the business, he can leave that child the business, but his other child that's not involved in the business, well, that's not fair, is it? No. Well, all of a sudden that child gets $1 million cash from the life insurance, or $2 million cash. Or what about the real estate property? There's a bunch of tax payable on that. The family cottage went up in value big time, bunch of tax on that. And there's a bunch of tax because he's deemed to have sold the business when he died. All those problems go away because we have millions of dollars of tax-free death benefit. That's how powerful the infinite banking concept is. That's why wealthy people and everyday Canadians are using it every day. And that's why over $100 billion are in it in Canada.
That was an awesome recap. That was very good. And it does show the potential of what these policies can do, right? If you utilize it. But I want to go back and reiterate the importance of working with someone that specializes in it. As you were going through each of those years for the individual, for the client, they would have had to contact that person that specializes in the strategy each and every time, right? When they were taking those loans for their business, what was the best way to do it, the best way to repay it? That year where things were bad, to have those, to have the ability, the flexibility built in to be able to do that. If you didn't do it right, you don't have that flexibility. It's not there, right? So all of those different times when we hit retirement, we want to set up a corporate insured retirement plan or an insured retirement plan. All those pieces are pieces that you need to be working with someone that specializes in it to make sure that it's done right.
Yeah. Again, the longer you plan on having this, the longer you're going to have someone to deal with, a firm that knows what they're doing. And if you plan on having it till death, because that's what it's set up to be, well, figure out when you're going to die and go, all right, how many years am I going to have to deal with someone? So in this example, we had a 25-year-old all the way up to age 90. And then, I'm sure at age 90, that child that's running the business and the other child, there's probably policies on them. Who's going to understand how they work? Who's going to explain to those kids what they can do with their policies? So yeah, that's huge, Christina. What's next, Christina, before we wrap up here?
Well, I think for people listening out there that are thinking, hey, this might be something that I want to learn more about, it might be right for me, I do think that the next step is learning more. So we've got a ton of resources on our website. We've got webinars, we've got our podcast, we've got your best-selling books, Be the Bank or Infinite Banking for Real Estate Investors that people can check out, learn more. When you're ready to take that next step, as I mentioned, work with someone that specializes in it. Control and Compound, this is what we do. We specialize in the infinite banking strategy for real estate investors, business owners, people that want to be wealthy, that want to grow their wealth, right? So we also offer education sessions with our wealth coaches. So make sure you check out our website, learn more, and take that next step.
All right. So you might know the expression, knowledge is power. We tried to share a bunch of knowledge here today, and knowledge is power is BS. Knowledge is power if you take action. So if you don't take action, there's no point in learning this knowledge. So we encourage you to reach out to us, book a free consultation with one of our wealth coaches, read the book, watch some podcasts, listen to the webinar, watch the webinar. That's it. Thanks for watching. Thanks for listening. Have a great day. Thanks for watching this episode of Control and Compound. Don't forget to subscribe and hit that bell button so you never miss a new episode. And if you're ready to learn more, head to our website, controlandcompound.com. The link's below.